And welcome to the Smart Money Simplified podcast with your host, Brent Mekosh. Brent, good to be with you again. How are you?
I'm doing great, Bill. I was away all last week, and so getting back into it this week, but it's been good so far. How about yourself?
Oh
How you
yeah,
doing?
I had a big dose of envy. I was following you and your exploits on LinkedIn.
Yeah.
So
It was a good week. We spent the week on a friend's boat in the Exumas in the Bahamas, and it was a fun time. But glad to be back. It's a good time to be coming back to Arizona. Arizona's pretty good the end of February now as well,
yeah,
so
I
can't
would
complain.
imagine.
Yeah.
So what's on the table today?
We're going to talk about a lot of things. I'm going to start talking about risk. And I think that this, obviously, for our business is an important topic. And it's a topic that I think, or an issue that I think that sometimes we can get wrong in this business. And I'm going to start with sort of looking back to the financial crisis, 2008, 2009. And I recall, I don't want to call out Goldman on this because it may not have been a Goldman analyst, but let's say it was an analyst from a major Wall Street firm when
There we
everything
go.
was falling apart was asked the question, well, how come no one modeled for this? And the answer was roughly, and I'm of course paraphrasing, was that what was occurring in the financial markets is something that should occur in one in every two or three universes, meaning it was, by their measure, was an improbable event that never should have happened.
Right.
But those of us that have been engaged in the financial markets for a long time, and I'm coming up now on about 30 years myself, you realize that these extreme events happen a lot more frequently than most people account for, than most modeling accounts for. I think that it's a weakness of our business. I don't think it's an intentional one. I think it's just based on the nature of trying to guess what might happen, or at least come up with the best ideas what might happen in the future, that everything kind of works in smooth, straight lines, but life isn't like that. Returns are not evenly distributed. The likelihood of extreme events, typically to the downside, are a little higher than most of us think. And that, when we've formed the Wealth Stewards here, Jeff and I, that was something that we really wanted to try to get a handle on. And we felt that for our firm, one of the best things to do was to go out and find an external chief investment officer that we could advise and consult with, that would help us build our models to potentially, you're never going to fully protect from that downside, but at least account for it in a way that I think is better than most, if not the vast majority of the firms are doing. Through that search, we came to Fiducient Advisors and Joe Cortese, and he really helped us build out the models that we're using here at the Wealth Stewards, along with his entire team over there at Fiducient. And so we've got Joe on here today. He's extremely busy, so I'm very happy to have him here. He is a partner and senior consultant with Fiducient. And Joe, it's great to see you with a beautiful Chicago skyline in the background there. But yeah, so thanks for carving out this time to speak with me today. And do you want to start with a little bit of your background story, how you ended up with at Fiducient and how you got into this business?
Sure, certainly. Yeah, we timed it right. We got one of the only sunny days in February in Chicago, as you can see. So it's a good day to do it. But by way of background, I'm a partner with Fiducient. I've been with the firm for 15 years. I started on the private wealth side of the business, out of school, literally at the bottom of the totem pole, as a client service associate for a private wealth office for Morgan Stanley here in the Chicagoland area. That was a great experience for me because it was a very broad purview into what happens in the world of private wealth, the world of wealth management generally, financial markets generally, capital markets generally, very broad purview. And then I left to go work for a local family office that was a client of that Morgan Stanley office, that asked me to come and work for them directly. So that was another really interesting experience, just working with one family and helping them oversee their assets and all the interesting things that go on there, particularly the family dynamic side of things, which can be volatile in the family office space, to say the least. And then I found Fiducient. At the time, a much smaller organization than we are today. We were 25 billion in assets and 35 people at that time. And, today we're north of 330 billion assets under management and advisements total, and 215 people. So have been a part of and been great to experience that tremendous growth, which has been phenomenal. And then, that experience in the private wealth side of things and the wealth management side of things kind of lended itself to working with other financial institutions that would approach us in the early days and ask for our help. Hey, Fiducient, I'm a trustee on a university endowment. You're doing great work for the endowment. I have a wealth management business. Can you help me? And we would pick up a client like that every couple of years. And I started working with some of those clients in the early days of what we were doing there. And then we formalized this outsourcing practice about 8 years ago. And so I transitioned full-time to help launch the outsourcing practice and have been working primarily in that business for the last 8 years.
So give me the background on Fiducient. Who are you guys, and the genesis of the firm? You've been there, I believe, since 2008, and you talked about the growth of the firm since that period of time. But what exactly do you guys do for those of us that the listeners that may not know anything about you?
Yeah, so we're an independent investment consultant, and to us, that independence, which is a very important core value of the firm, it means that we don't have any product. So I don't have any fiduciant asset management strategies that I'm marketing. Our product is our investment consulting and oversight services, intellectual property that we provide our clients. And that's the only place where our revenue comes from. And so that's very important to the firm. We've got really 4 businesses, 3 of which are where we're working directly with end clients on a B2C basis. And those include our corporate retirement plan practice, where we work on 401k plans, cash balance, pension, those sorts of anything under that sort of ERISA umbrella goes in the corporate retirement plan practice. We have an institutional endowment, foundation, and nonprofit practice where we help oversee tax-exempt pools of capital. And then we have the private consulting practice, which is the private wealth management business where I originally joined the firm. So those are our 3 B2C businesses. And then we have the B2B business, which is the financial institutions outsourcing practice, which I'm leading today. So those are the 4 businesses of the firm. The assets that we're responsible for, just north of 330 billion today, that we AUM and AUA that we oversee on behalf of those 3 businesses that I described. And then in the 4th business, the outsourcing practice, we're working with about 80 firms. They range in size from a couple $100 million in assets to some of the largest firms in the country that are 10, 20, 30, 40 billion in assets and up. And if you kind of aggregate all the assets of the firms that we're working with, it's north of 200 billion. We don't see those assets. We don't see the end client accounts or those sorts of things, but those firms look to us to help place those assets by virtue of the outsourced investment research consulting support that we provide as sort of an outsourced chief investment officer.
So directly or indirectly, Fiducient has some sway anyway on about 580 to $600 billion worth of assets.
Yes, that's exactly right.
Got it. Now, one of you mentioned 2 things there that I think are important, but I'll start with this idea that you don't have any proprietary products. And I know for us at the Wealth Stewards, that was a big one. There was some great people that we spoke with, but they wanted to get a seat inside of our portfolios to help do this work for us. And we felt that as good as many of the products were with some of these companies that we were speaking with, we didn't want there to be any appearance of conflict of interest. And is that's obviously been something that's been important to you as well?
Yeah, it's one of the founding core principles of the firm. And it allows us to the greatest extent possible, go to the marketplace, take an objective view of the solutions that are available, and then bring those solutions to bear on behalf of our clients without a horse in the race monetarily. No, managers don't pay us to be included in our recommended list. They don't pay us to be included in our database. They don't sponsor our conferences, those sorts of things. So we're very careful about doing whatever we can to minimize potential conflicts of interest in our business. You can never eliminate them 100%. That's the world that we live in, but we try to do our best to minimize them to the greatest extent.
Now, let's talk a little bit about risk, because I think that is probably what we were most impressed by when we began our conversation with you. I brought up an illustration of something that occurred during the financial crisis, that these returns are not normalized. They're skewed. They're definitely very prone to there's some downside bias to that.
Yeah.
Now, you guys have your Frontier engine. Do you want to talk a little bit about how you view risk and how you use the tools at your disposal to try to get a better handle on controlling the risk?
Sure, absolutely. But let me zoom out for just a second and
please.
say the reason we're able to do all of this is because, when we founded the firm nearly 30 years ago, we decided we were going to build an in-house research engine. That was a decision from day one, and we've really done that. So today we have nearly 40 folks at our firm that participate in our investment research effort, and upwards of 30 of those folks are really full-time dedicated to research. So they have no client-facing, no revenue responsibility. Their job is investment research, day in, day out, all day, every day. So, and that's where, what we'll talk about today, that's where our findings emanate from, is the work that centralized research office does. All of what we do is really grounded in academic work and research in the landscape. The notion that asset allocation drives the preponderance of portfolio variance, and taking a very academic look at financial markets and portfolio construction, but then overlaying the pragmatic considerations on top of that. If you exist only in an academic world, what you end up, the solutions that you'll end up with many times aren't applicable, or aren't as applicable in the real world when you take taxes into consideration, and trading friction, and custody, like all the things that clients at the end of the day and their preferences and what they see. So we start with the academic approach, we layer on the pragmatic approach, and gets us to what we believe is an optimal solution in the marketplace for clients. But then, to your question about risk, portfolio construction, the frontier engineer, we decided to build our own portfolio optimizer about 20 years ago because we didn't like the tools that were available in the marketplace. And you're speaking to exactly one of the main reasons why we did that. Most optimizers that are out there, as you sort of said early on, they assume that normal distribution of returns when you're modeling asset classes and return and risk outcomes. But to your point, that's not the way the real world works. And so we built the Frontier Engineer to incorporate the non-normality of return distributions for asset classes and for portfolios. Don't want to get too technical here, but statistical measures like skewness, kurtosis, those fat tails that many frameworks aren't able to incorporate, we are able to incorporate with the Frontier Engineer. And so it just gives us a better purview of the risks that we're actually taking in portfolios, and helps us help our clients make more informed decisions about the portfolios that they're implementing and that they have. Because if you assume normal distribution of return, your estimation of sort of worst case downside scenario using a value at risk framework, something like that, you're gonna miss a meaningful component of potential risk. And so that translates, if you look at it on a volatility basis, 5 to 10% of additional potential downside in portfolios is not going to be captured in that normal distribution framework, versus being able to incorporate non-normality of return distributions and all of those sorts of things.
Well, I think what you also see when these markets get a little bit dicey is asset classes that historically in normal times are not correlated suddenly become very correlated. And is that something that your modeling takes into account?
It does. We have the ability to factor in when we're using the Frontier Engineer to do portfolio simulations, which ultimately gets us to our strategic allocations. It is doing that. It is incorporating, it has the ability to factor in dynamic correlations, trending, reverting, reversion to the mean, those sorts of things. So in the thousands of simulations that we're doing, some simulations will be good, where markets are up and doing well. Other simulations will be catastrophic in nature, where correlations are going to 1, and the best performing asset class is cash, and those types of scenarios, like a 2008 sort of financial crisis. Now, thankfully, those are small in number, but great in magnitude. And so that leads us to, ultimately more of a broadly diversified portfolio, so that we can try to minimize some of that volatility. You can't get away from it completely ever, but more of a broadly diversified all-weather type of a portfolio that will allow us to participate when markets do well, but will help us protect value when markets aren't doing well. And that's really the important part of it.
Now, do you think that the reason that other firms are not necessarily embracing that viewpoint is because obviously when times are good and people are making money, and we've had a couple of years of that, the tendency can be to get a little bit greedy, and that downside protection is not important until the day that it is. Do you think that the failure for a lot of other firms to embrace this idea that you know what, look, if markets are performing well, generally speaking, everyone's going to participate. Um, but it's that downside protection that really is what, to your point, can be catastrophic. And why isn't that being taken into account to a greater degree across the industry, do you think?
I think part of it is you just have to look at the industry structurally, right? So there are 18,000 advisory firms in this country, give or take, roughly. Firms that have $1 billion in assets under management are in the top 10% of that 18,000. And so there's a huge tail of small firms, one advisor, two advisor type firms. And often the case is they just don't have the level of sophistication. They don't have the resources to do what larger firms like ours can do on the investment research side. And so that's just part of it. Structurally, most firms out there just don't have the resources to do it. And then beyond that, it's not easy. It's taken us 30 years to get to where we are today in terms of, this institutional framework that we're implementing. It's taken us 20 years to build out the frontier engineer from when we started and get to where we are and be able to model these different types of risks and portfolios and those sorts of things. So it's just something you can't really do, sort of day one off the shelf by yourself. And so it takes time and effort and energy. It takes sophistication. It takes academic rigor and study and all of those things to get there. And it's one of the competitive advantages of our firm because we decided to do it, 30 years ago when we originally started in this business and 20 years ago when we built out the Frontier Engineer framework.
Now, what do you do with your research team to insulate them from the market, the noise, the news cycle, the chatter, and trying to chase whatever that hotter asset class might be? Do you have guardrails and constraints on them?
We do. Part of it is just how we do this. So we take a long-term strategic view when it comes to building portfolios and the asset allocation process. We do our own proprietary capital market forecast assumptions. Those forecasts are 10-year forecasts. So the team takes a 10-year view on markets, comes up with our estimates for annualized return, risk, and correlation. Those are the inputs that go into the portfolio construction model. So our entire process is long-term oriented. So to your question about how do you filter out the short-term noise, part of it is just taking a long-term orientation and how you're doing this. Now, we also know that you can't build a portfolio today, go to sleep for 10 years, and then wake up and see how you did, right? That doesn't make a lot of sense. So while our process is long-term strategic oriented, we update it on an annual basis. So taking a long-term view helps us filter out the short-term noise and the short-term market machinations that you're never going to be able to predict effectively. But then updating that long-term view on an annual basis allows us to account for what happens in markets over time. So we view it as taking a long-term strategic approach, but integrating a more active portion of the process so that we're accounting for changes in valuation across asset classes, structural changes in asset classes that happen over time, all of those sorts of things. So it's an integrated approach to asset allocation, which allows us to do that.
Now, looking at where we are in history, I think this is a very unique time to be an investor because we've come off a couple pretty good years, but we've come off a couple of years that have really been driven by the strength of a very, very small group of stocks in the S&P 500. Yeah. And we've also been in a sweet spot here really since the financial crisis where the only game in town has been U.S. large cap, essentially. Right. The rest of the world just has not performed. Small cap has lagged, international has lagged, emerging markets have essentially gone nowhere. We've had the bond bull market that lasted about 40 plus years that seems to be over at this point. How do you view the landscape coming into 2025, and what are some of the proactive steps that Fiducient is taking to try to protect against this really significant concentration we have, where you've got managers around not just the United States but around the world are chasing just a couple very limited opportunities?
Yeah. Right. Yeah. We, and in fact, in our annual outlook, that we wrote at the beginning of the year, concentration was one of the themes. Really fragility across markets that it sort of manifests into this notion of fragility, where markets seem vulnerable. whether you're talking about fixed income, where there's a lot of uncertainty about Fed interest rate policy and what that's going to mean for bonds, and the potential for inflation to reaccelerate as we've seen over the last couple months here, and how that's all going to play out on the interest rate and fixed income side. On the equity side, the concentration is a huge issue. A great example of this is the NVIDIA DeepSeek saga that we saw a few weeks ago, right?
Yep.
There's some announcement out of China of a new large language model that they said was much less expensive to build and run, which turns out that wasn't probably really the case. That's a whole nother conversation. But on that day, NVIDIA drops 17, 18%, erases 800 billion and 600, I think 600, 800 billion in market cap in one day, the largest one-day market cap decline of any company in the S&P 500 in history, and caused the market to be down almost 2% that day because of that one stock in particular. And so there's not a ton. I mean, candidly, there's not a ton you can do there. This is the way markets have evolved. The top 10 companies in the S&P 500 today represent almost 40% of the value of the market cap of the market today. There's just not a lot you can do to get around that, other than continuing to maintain a broadly diversified stance in portfolios. We are proponents of a passive approach on the U.S. large cap equity side, because our research has shown that it's extremely difficult for active managers to outperform over the long run in the U.S. equity space, large cap equity space, I should say. And when they do outperform, the magnitude of that outperformance is minor. And so it's really hard to do that. So outside of like moving to an active approach in U.S. large cap equity or something like that, which we think is extremely difficult to do in terms of predicting a manager that's actually going to meet what the market does or outperform, the way you protect against that is to maintain a broadly diversified stance, have different asset classes in portfolios, thoughtfully diversify the exposures around, what we see is probably going to be some volatility as a result of the concentration dynamic that we're seeing today.
Well, let's talk about that active versus passive, and that's an area where we're certainly in agreement, where there's certain asset classes that to a large degree are commoditized at this point. There's other areas where to pay for that active manager makes sense. And I think the key with building portfolios is there's always a cost component to these things in terms of how much cost you're gonna integrate into that portfolio. And so the question becomes, where are you going to spend your money? And to your point, large cap US, why spend the money there? Because you can get the index for an extremely low price. But is there a place where you think that money is better spent to pay for that active management, to pay for people that are deep in that world every single day?
Yeah, there are a few places in portfolios today where we're advocates of active management. Firstly, on the fixed income side, fixed income bonds remains a relatively inefficient market relative to like U.S. large cap equity, S&P 500, those sorts of things. And you've got, a market with a bunch of different types of bonds that trade very differently. It's a big market. It's bigger than the equity market. And so there is the opportunity for managers to add value there. Also, benchmarking is a bit of an issue too.
Right.
There's a lot we could talk about just in terms of, benchmarks aren't great on the fixed income side compared to the equity side. So there is, when you look at fixed income, there is persistency of alpha, there's consistency of alpha. And so it does, our research shows, does make sense to be active in the fixed income side of things. In the international and emerging market equity sections of the portfolio, the research shows that there is some consistency and persistency of alpha and ability to outperform there. That goes back to, if you think about the US equity market, it's one country, it's one set of laws, it's one currency, it's one set of accounting regulations, it's one market. Versus you look internationally, you've got different countries, different languages, different currencies, different regulatory regimes, different accounting regimes, those sorts of things. So there's just more information, there's more opportunity to have an informational advantage because it's much more disparate universe of opportunities, a universe of companies that you can invest in outside of the US. And so in those markets, it does make sense to pay up for active management as well. And then you get into more of the esoteric alternative, those sorts of things, definitely, you know, active there. But when we're looking on the public side of the portfolio, it's fixed income, international emerging markets. There's a case to be made for small cap equity in terms of active management there. The research does show that there is some consistency and persistency of alpha on the small cap side. There's more companies there. It's less traffic institutionally. Many of the companies on the small cap end of the spectrum are still unprofitable. So active management can kind of weed out the lower quality things and focus on the higher quality things. But to your point, there's a cost associated with that, typically 50 basis points to 100 basis points for an institutional manager. So you have to be willing to bear those costs in order to do it. Also on the small cap side, we see much more dispersion across managers and relative to markets. So you have to be prepared to accept that level of dispersion if you're going to be active on the small cap. We're talking 500 to 1,000 basis points of dispersion is not unheard of for managers that ultimately finish in the top quartile of the peer group over a 10-year period of time.
Well, let's continue a little bit deeper dive into international. So on the advisor side, up until really this year, we made a much larger allocation towards international coming into 2025, which so far so good this year. It seems like the trend has changed a little bit, but it's been kind of a four-letter word because it is so radically underperformed U.S. markets, and we're at this point now where the global capitalization of the U.S. market versus the rest of the world is just absolutely massive. I think we're like 20-year discounts in terms of international markets. What do you see that? Do you, at some point there is reversion to the mean, and we are so extended now, U.S. assets versus international. Is it 2025, you think, are we at the start of a trend here? Because it feels like we are, or is it too soon to say?
Yeah, I mean, that's the trillion-dollar question, right? A few things I'll point out. If you look at the U.S. equity market relative to global GDP, U.S. equities represent about 65% of global market caps today. So 35% still remains outside of the U.S. If you look at S&P 500 market cap to global GDP, it's at an all-time high. If you look, this has been the longest stretch of U.S. outperformance, kind of historically relative to the rest of the world as well, going back decades. You talked about valuations, PEs in the US relative to the rest of the world are at all-time highs. So all of these indicators are flashing that, we're sort of in the late cycle of US outperformance here. But can it continue? Yes, absolutely. I mean, that's the thing. We're never going to be able to time it right. This year has been interesting so far. We had seen this in 2022 and 2023, where international and emerging markets got out to a bit of a lead relative to the U.S. very early on. But typically by the end of January, that was over and U.S. was outperforming again. We're sitting here today. I just looked at the numbers this morning. EFA international, developed international is up about 9%. Emerging markets is up about 5.5% year to date. And the S&P 500 is at about 1.5% year to date, given the volatility that we've seen over the last few days here. That's a big spread. That's the biggest spread that we've seen over the last few years in terms of non-US outperformance. And it's also the longest stretch, if you take, Jan 1 as the start date, that we've seen in the last few years. So is this the year where we're going to see some international and emerging market outperformance relative to U.S. equities? I don't know if I can make that prediction, but it's pretty stark so far. 2 months into the year.
And how about the rise of alternatives within portfolios, both obviously private markets all the way down to liquid alts? That was another thing that to us, at least here at the Wealth Stewards, was attractive about working with you. Is I think you guys got that. You got that idea that we need to be incorporating more of these in portfolios. What do investors or other RIAs need to know about incorporating these alternative asset classes into investor portfolios?
Yeah, so it goes back to your, the comments about how do you deal with concentration, how do you deal with fragile markets, all of those sorts of things. So yes, looking for lower correlated assets to include in portfolios to provide some downside protection. It's absolutely part of the strategy. It's always part of the strategy, but there's a greater reliance on that today, given just where markets are. But you have to be very careful about how you do it. These products come with liquidity provisions. Some are less liquid, some are completely illiquid. Fees tend to be higher. Administrative requirements are higher relative to public market investments. So there's a lot you have to take into consideration when you start adding alternatives, we'll call them, to portfolios. We have a long history of doing it and experience in doing it. But you just have to be careful. And then also this proliferation of alternative options in the marketplace. You really have to be careful about what you're adding to portfolios today. Asset managers are rushing to market with alternative investment opportunities for clients, and this democratization of alternatives has been a bit of a buzz phrase here over the last couple of years, but it's a real thing. I mean, asset managers are, really pushing product into the marketplace, and so having experience evaluating these products, because they're different than public market investments, being able to parse through all the important considerations, understanding what is really valid from an investment thesis and an investment case in a portfolio versus marketing and fluff and what's ultimately not going to produce a better outcome for the client. That takes a tremendous amount of experience and expertise in order to do that.
And now, do you think that an advisor team, I know what the answer to this is, it's probably not the best question, but can an advisor team do that themselves?
No, I mean, frankly, the answer is no. I mean,
no, I agree with you.
If you, I mean, maybe I think the probability would be very low. I mean, we have a dedicated marketable alternatives team, which is a few individuals. We have a dedicated private marketable alternatives as industry speak for hedge funds, by the way, just in case. So we've got a dedicated team there. We've got a dedicated private markets team of 5 individuals that all they do is private markets research. And just that's 5 people. They're spending their entire day working in private equity, private real estate, private credit to figure out what's going on there, to build relationships, to get access to those sorts of things, to avoid the things that we don't think are going to produce good outcomes in portfolios. So if you think about an advisory group that, where advisors are dealing with clients all day, but then like trying to diligence alternative investments to add in portfolios, I mean, it's kind of an impossible task, really.
Yeah, I agree with that 100%. Now, obviously, a hot button topic is artificial intelligence. How do you see AI being integrated into your business and also some of the RIAs that you're advising on?
Yeah, well, we're working really hard to integrate AI into our day-to-day, and we have an enterprise applications team here that's 4 or 5 individuals that deals with all the data, all the systems, AI, all those sorts of things. I think a few things. One, AI is really helping us get a handle around our data. Just the massive amounts of data, client data, investment data, return data, due diligence data, like all that. AI is helping us better organize all of that data. And it manifests in dashboards that we can look at to see how efficiently we're running our business. It manifests in dashboards to go through the investment book and look at how the investments are doing, exposures, being able to slice and dice it in different ways. That's part of it. Productivity enhancements has been huge for us. I'll give you an example. Like we use Microsoft Copilot when we're in meetings with clients to take notes in the background. And then at the end of the meeting, we'll use Copilot to summarize the notes. So gone are the days of me like doing a client meeting, trying to present information, take notes at the same time, not being, fully engaged in either side of things, where I can now just have a conversation, have a meeting with clients, the note takers in the background, and at the end of the meeting, summarize meeting, spits out a summary that's 80 to 90% accurate. I tweak it a little bit just to make sure it captures everything I need it to capture, and then that goes into our CRM. So the productivity gains there are massive. So we're spending a lot of time, and I don't think, this is just, obviously this is a huge mega trend in the industry, and we'll continue to, find new ways to incorporate AI and technology and all of that. I think firms that aren't focused on that are going to be left behind, frankly. I don't think, at least in the short run, maybe I'm biased here, but I don't think it's going to replace us as financial advisors, not going to replace financial advisors. It's a tool to make us more productive. It's a tool to enhance what we can do on behalf of clients. It's a tool to enhance how we run our businesses, make us more efficient, those sorts of things. And it's really exciting kind of what's available today and what I see happening there in the future.
Yeah, the leverage, at least here at our team that we've got, and we use Zox in much the same way that you're using Copilot. And yeah, to your point, in the past, you'd be sitting there scribbling down all these different notes, and you would miss 40% of it because you were scribbling around the other 60% of it.
Yeah.
Whereas now you can sit down and be fully present with the client and listen to them, knowing that details that you would have otherwise missed are being captured in the background. I think that's extremely powerful. And to your point, I think for teams that are leveraging it to better build those personal connections with clients and to truly serve them, it's going to be a fantastic set of tools that we can bring to the equation. There's no question. But are you seeing it yet, AI being involved at all in portfolio construction on your end?
Yes, to a degree. On the investment due diligence side, the way we're using AI, and this is in very early stages and something that we're spending a lot of time on continuing to build out, but just like feeding portfolio and asset manager data into the model and having it spit out attribution information and commentary to help us make decisions around the investments that we're making. We're not to the point where the AI says, hey, buy this and sell that. Like, that's not what we do. But as a tool, and as a tool to enhance the work that our researchers are doing there, absolutely, we have incorporated it early days and are racing to do more there and spending a lot of time and resources to make that happen. And it's, I think we're in the infancy of all this, certainly, and it will just continue to grow over time.
Now, you work with obviously a number of teams around the country. You mentioned 80 different RIAs. What do you find that the best teams, and this question's more for both other RIAs that might be listening to this conversation or curious about what you can do to help them. It's also to investors that are thinking about perhaps maybe the people that they're working with, wondering if they're doing this correctly as well.
Yeah.
What are some of the things that you see the best teams around the country doing? And that could be everything from the investment research piece, which obviously you help on, to client services, to everything in between.
Yeah, I would say technology is a big thing in the industry generally. For whatever reason, the wealth management industry kind of was woefully behind from a technology standpoint, many other industries in this country. So the firms that are embracing technological enhancements are having success implementing technology solutions for the client experience, to run their business, become more efficient, those sorts of things. Those are the firms that I see are having the most success, that are growing the fastest, that are out there, that are attracting the most clients, for sure. Being laser focused on that client experience. It's easy stuff. Well, it's easy to say, having clients being able to do things on their phone, which is what clients want to do these days, and eliminating paper documentation, like all of that sort of stuff. It's easy to say, but it's hard to do correctly and efficiently. And so the firms that are having the most success are winning in those roles. Again, I'm leading an outsourced investment research practice, so I'm biased, but those firms that are embracing outsourcing, for not only on the investment side, but just building an ecosystem of outsourced providers where they're gonna retain whatever piece of the business that it is that they're best at. Always includes the client relationship aspect of things, because that's the really important part of kind of how we drive all of this forward, is building those client relationships, maintaining them, those sorts of things. But firms that are building an ecosystem of providers around that tend to be the most efficient, tend to be the most cost effective, tend to have the most well-run businesses that are out there. And the good news is that there's just been a proliferation of options in order to outsource various parts of the business, including the back office research function as well. Many firms that I work with retain a portion of what they do on the research side, and that's great. So they're kind of driving the bus, setting the strategy, and then looking to us as a supplement, as the engine behind it to make it go. And so that's another really effective way I see firms accomplish that side of things as well.
This is kind of a loaded question, but in our business on the advisory side, it's a graying business. The average age of an
Yeah,
advisor is going up,
yeah.
probably if not 60, it's getting close to that. And do you find that some of these older teams are adapting to the new technology and adapting to the way that the world is going in terms of outsourcing some of these things? Because I can say from experience and now being in this business for a while, I think the most dangerous thing you can do is not just in this business, but any business is get really set in your ways and say, well, this is just the way we do things. And I see it a lot with other teams where, well, no, we've always done it this way, and we handle 100% of the investment management ourselves. And no, I don't. My clients don't need any of that technology, and it wouldn't help me anyway. Are you seeing that? Is there an is there a is there a period of time where almost you can't teach that old dog new tricks? And I know that's I apologize to any of our listeners that might be a little bit older out there. I don't mean that in a negative context, but are you seeing that maybe some of those teams are slow to adapt?
Yeah, and to that point, I would say it's less of an age dynamic. Um, and I would look at it more the way I would kind of think about it is like the firms that are growing, that are looking to grow, that have a growth plan, they tend to be the ones that are embracing the technological change and spending the time and the energy and the resources to figure it out, because that's what's really going to drive growth. The firms, the advisors that are sort of later on, they're maybe looking at some point to divest their book and going to retire, which is great. Everybody deserves to do that, right? Like that's the goal for many folks. But they tend to be less focused on adopting the latest and the greatest of the technology. To your point, maybe a little more set in their ways, those sorts of things. And that's kind of how I would look at it. It's those firms that are really looking to grow, are dynamic, those sorts of things where we're seeing more success on the technological adaptation front.
Got it. Got it. Any kind of final thoughts to folks listening to this about thoughts for 2025, thoughts about industry trends, and then we'll wrap that up with how they can reach you if they want to learn more about the work that you do with Fiducient.
Yeah, no, I would just say, buckle up. It's probably going to be a volatile year. Clearly, we're coming into this year with fragile markets to begin with, as we've discussed. And then you talk about the uncertainty around a new, administration and what they want to do with trade and tariffs and all of those sorts of things. And then you've got geopolitical uncertainty on top of that with the situation in Europe and in the Middle East and China. And there's just a lot going on. There's always a lot going on in financial markets. But the way we talk about it is like the outcome, the distribution of outcomes seems to be wider today than it has been in a long time, which means, you really need to be sure of what you're doing in portfolios. And we'd like to think we can really help ensure that your portfolios are in the right place, and that there aren't any hidden risks out there that you're just unaware of.
Well, I would add to that that at least in our experience working with you, which is now I think we're coming on about 6 months or so that we've worked together, that having your team as a resource for us to leverage on behalf of our clients for us has been very powerful. So I want to thank you for that.
Well, that's what we're here for. Thank you. Appreciate the partnership.
Great conversation, Brent. I was actually fascinated by it, and I'm curious, and I'm sure some of your listeners may be as well. If they're not already a client of yours or not familiar with you, what is the best way for them to maybe reach out and have a little longer, more detailed conversation and see maybe if they're a fit for your practice?
Yeah,
Sure. Well, I'd say
absolutely.
start with the website, fiducient.com, Fiducient, fiducient.com.
Mhm.
You can get a hold of us through the website. It's got all the information there. Certainly if you want to make my contact information available along with the show here, I'm happy to have a conversation with anyone as well. So yeah, whatever we can do to be a resource in the marketplace, we hold ourselves out to trying to be a good partner out there. So feel free to reach out.
Excellent. Excellent. And for those of you listening, that will be in the show notes in case you're thinking, God, wait, I didn't have a pencil to write that down.
Thank you.
And Brett, what is your contact information as well?
Our website, tws.finance, has pretty much every conceivable way to reach us. Number here at the office is 602-255-0555. And I'm pretty active on LinkedIn, and I'm on there at some point every single day. And if you DM me on LinkedIn, it is me on the other side of it. It's not a bot. And so we'd love to get some feedback and hear from you that way as well.
Yeah, the prospect of an AI Brent Mekosh is a little unnerving. Okay.
Yeah, we don't need more than one.
We
need
do
to
not.
duplicate and
We
duplicate.
do, but you couldn't be duplicated anyway. So, for those of you who are listening to this podcast who are not subscribers, there's something you can do that really involves very little commitment. You just have to reach out and hit the follow button and become a subscriber. That way, every time a new episode of this podcast is released, you're notified, and then you can give it a listen. And I would add to that, if you like this podcast, if you find it interesting, informative, useful, helpful even, share it with people. Tell people you like it. Turn them on to it, because word of mouth promotion is very welcome. It's a great tool, and we would very much appreciate it. Until next time, I'm Bill Tucker. On behalf of Brent and everybody at the Wealth Stewards, thank you so much for taking the time to listen today. And remember, you can go out today and make today a good day or not. It is your choice. Thanks for listening.